Hi, my name is Steven Staats, and I'm developing this video on investing, spending, and saving fundamentals primarily for my kids so they can use it as a reference when they get older and throughout life. But if it's something that you might appreciate or to play for your kids or for yourself, if you're like me, where your parents didn't give you a lot of guidance when it comes to money management financials, which is ironic since my father was an expert at it. Um, but I think he just thought maybe I would just soak it in and absorb it naturally. But we need to be taught some of these fundamentals that are important as we go through life. And the one gift my parents did give me that was very important when it comes to this aspect of life is a subscription to the Wall Street Journal, where I learned a lot of fundamentals. But I am not a certified financial planner, so understand that. But if you get anything out of today's video, uh, appreciate you using that. And if you are someone from outside of the family that appreciates this information, please just forgive the background of my messy bedroom. Anyway, let's get started on some general rules. Starting at a young age over time, you can become a millionaire simply by sticking with a solid investment plan. But just remember, it's very easy to burn through even $1 million if you spend extravagantly and or don't have an ongoing salary or steady income. A lot of people will inherit a sum of money, or they will work their way up, or they'll get a very strong paying gig that lasts for a few years, like professional sports, for instance. And then they blow all their money and they end up broke because they don't understand the fundamentals of saving that money and how easy it is to burn through money when you don't have a regular income. Quick side note, random, little bit of trivia, but the slang term for money, which is buck, dates back to when people traded deer skins or bucks as a form of currency before modern day money. There's that little bit of trivia for you. That's why we say $1 million, and it's really $1 million, right? Another fundamental, don't spend more than 25% of your monthly take-home pay, which is your net income, that's the pay after taxes have been taken out, on your mortgage, which mortgage is basically just a home loan, usually provided by a bank, or rent. You may choose a smaller, cheaper space to live in or find roommates to reduce the cost to stay in this 25% range, but it's very important. You don't want to be house poor, as they call it. Also, make sure you save money until you have at least 6 months of living expenses covered in the event of a job loss, a medical emergency, a pandemic, or other emergency. Also, try to put 15% of your salary into savings programs. Many companies, especially large corporations, offer 401k plans. That's named after the tax code line item. But they offer tax incentives for investing. You can also do IRAs, which is short for individual retirement accounts. And when given a choice, most economists will recommend that you use a Roth IRA that's named after the congressman who introduced the bill originally, which many certified financial planners think have better tax incentives than traditional IRAs. But either one offers some tax incentives just in different ways. Also, a lot of experts recommend people not rely on the federal Old Age Survivors and Disability Insurance Program, or OASDI, often referred to as Social Security. This is the money that the government takes out of your work paycheck for retirement if and when you're too old to work a daily job. Since the US can print money to pay people back, I don't expect the institution will actually run out of money like others think. But I do believe over time, inflation will devalue this money that you get back later in life, even though they raise the amount occasionally. In any scenario, Social Security alone will likely not offer you a comfortable retirement, so don't rely on it. Also, make sure you give to charity. It helps an important cause, makes you feel good, and it is a tax write-off incentive. That means it reduces your taxable income, so that's positive. But it's nice to do things for other people regardless. Cars, keep in mind, cars are the priciest items that you will ever buy outside of houses, probably, for most people. So be smart and do your research on the reliability and cost of the brand you want. Unlike buying a house, which can sometimes appreciate, which means go up in value over time, most automobiles depreciate in value. There's only been one point in my lifetime where used cars actually appreciated, but that is historically uncommon. since new cars generally will lose a large portion of the value the second you drive them off the lot. Often a used car without too much mileage in the 2 to 3 year old range can be your best bet for your money. Don't use debit cards outside of just getting cash out of your ATM. Debit cards pull money directly from your bank real time, so if someone steals that number, it is more of a problem than credit cards to get it corrected. That money just comes out directly and you've got to chase the money or work with your bank to ever see it again. With credit cards, you're actually paying with another company's money that you can dispute the charges if necessary from fraud or unfair business transactions. Credit cards often can offer benefits such as cash back, airline miles, that kind of thing. Just make sure you pay off any charges in full at the end of each month so you don't incur interest charges, which can be extensive and gets a lot of undisciplined people into a lot of trouble with heavy debt and stress. So credit cards are not bad as long as you pay them off. They can be used, when used properly, they can be very beneficial. After saving, investing and donating, spend some money just to have fun. Spending on experiences like travel and life experiences and events and getting together with friends and family, that kind of thing, versus material things have been proven to be more valuable to most people's happiness over time. Now let's talk about saving. Online only accounts have the best rates on saving accounts. Certificates of deposit, or CDs as they're known, and or money markets often will pay the highest interest rates. You can go to bankrate.com to see competing rates and who offers the best interest. It can literally mean the difference of hundreds or thousands or hundreds of thousands of dollars in the long run choosing the right savings account. You can look up the definition and benefits of these three types of accounts: certificates of deposit or money markets or savings accounts. But all of these choices are based on the bank paying you to use your money, and all are considered super safe. The federal government insures accounts up to $250,000 at the moment per bank. So unlike risks associated with investing in things like stocks, you won't ever lose your principal. That's the initial money you put into it, because the federal government will pay you back if, for instance, that bank goes out of business or something economically catastrophic happens. So just remember, most banks have, they call it FDIC, Federal Deposit Insurance Corporation, and they will cover any losses up to $250,000 that are not caused by you, but from the institution having an issue. Investing. Investing is an important aspect of building wealth, since just keeping money in a standard checking account often doesn't cover the inflation rate. For instance, you're actually losing the value of your money if your bank is paying you 1% interest, but goods and services are increasing by more than 1%, which is often the case. A diversified plan of cash, that's the physical paper money or money just kept in savings accounts, and stocks, which is the ownership in individual corporations, or REITs, which is short for real estate investment trusts, bonds, which are basically loans that you make to the government or corporations, and other alternative investments is ideal. Having a diversified portfolio is the best recommendation for investments by most certified financial planners. Invest for the long term so you can ride out the downturns, and don't try to make quick money. Most day traders lose big, but keep your own risk and reward tolerance in mind when choosing what to invest in and how much to invest. You can also buy treasury bonds, which are individual loans to the United States, and you can buy them directly from the federal government at treasurydirect.gov, thus bypassing brokers that take commission. So like if your investment goes up by 2%, but a broker is charging you 2% for their services, it doesn't help you at all. So you want to keep that in mind. The more you can do yourself and the more you can learn to do yourself, you'll save a lot of money in the long run. Anyway, these treasury bonds, especially the ones that are designated as Series I or I bonds, have to pay you back a certain amount of interest over the inflation rate. So to me, these are the safest investments, since the federal government can print money to pay you back if they have to. Conservative organizations like banks or credit unions will purchase treasury bonds for their investments because it is so safe. And you can do it yourself. At the moment, you can do it with as little as 25 bucks or as much as $10,000 per year. And there's a lot of benefits to these Treasury I bonds. I consider it one of the safest investments because of the fact that the government can print money. And at that point, if they can't, and you've got bigger issues than just your I bonds, if the government has gone down and the money system has collapsed. But we won't go to that apocalyptic aspect, because then all bets are off. Then you need just canned goods and guns. But anyway, for individual stocks, look for large companies that have been around for a while with low price to earnings ratios, or P to E ratios, and that have a dividend but not too high where the company can't afford to keep paying it, so that you get paid whether the price of the individual stock goes up or down. These annual dividends will provide you income, and you don't have to, as long as the company can stay in business and is a logical company and a large company that's got a lot of cash, and you're confident that you're going to make your money back, or it's not going to go out of business completely. I advise using companies that pay at least a little dividend, so you can ride out the market through the ups and downs. Individual investors can look up the information for each company on their computers or phones through multiple websites, including finance.yahoo.com. Apple, Disney, Boeing, Pfizer, Chevron, 3M, Johnson & Johnson, Microsoft, they're all considered good long-term companies if you can get them cheaply when the overall stock market is down. These are called blue chip companies, named after the color of the poker chip with the highest value. So you can look at these companies that you want personally, and maybe you use their products or services yourself and feel that they have potential to grow. Fidelity.com is a very good conservative brokerage for buying stocks. Stay away from the get-rich-quick apps that, in my opinion, try to turn investing into a video game and can encourage bad investing behavior, which can result in losing money. Young traders new to investing are particularly prone to making the mistake of jumping on the bandwagon of a new trend. Disconnecting emotion and acting opposite of the herd is often a winning strategy, in my opinion. So when people are excited about the stock market and things are going well and there's all this optimism for the future, that's sometimes the time to get out of the market. And when everyone thinks everything is in the dump house, that's often a time to get in. So think opposite of the herd in general. Learn to invest yourself. Like I said, paying a broker commission just wastes money, in my opinion. And you can even use Fidelity to buy individual corporate bonds. These are essentially loans to corporations where they agree to pay you back with interest by a certain date. Choose companies that are rated by investment firms like Moody's, with the highest ratings, usually designated with A's or B's. Buying lower than investment grade companies have a less chance of paying you back. These are called junk bonds, and they're considered very risky. You can also buy bonds for government agencies, states, or cities. When you buy a bond of a particular city, they're called municipal bonds or muni bonds, and they have tax advantages often. But like corporations, some cities are more risky than others, and they cannot print money to pay you back if something goes wrong, like the federal government can. If you don't want to research individual investments like stocks or bonds, I'd recommend just doing a mix of funds. The funds are money pooled by multiple investors in various investment categories. Like, for instance, some of these that I'll just throw out there, like JRS is a real estate investment income fund. They invest in a large array of real estate investments. Or SPHIX, which is a high income fund. Or TEI, Foreign Companies Income Fund. Or OHI, these are all ticker symbols, as they call them in the stock market. So how you look up a particular fund is by usually these 3 to 5 letters. But OHI or OHI is a healthcare investment fund. XLU is a utilities sector fund, if you believe in investing in utilities. VWEHX is a high yield bond fund. Those are ones that invest in junk bonds, but they try to have a more balanced portfolio. So if one company goes out of business, you've made enough money on the other companies where you're still getting in some income and you're safer. But once again, depending on the economy, things can go sour on those as well. VWEHX, that's another that's the high yield bond we just talked about. FFRHX, that's a floating rate income fund. So they invest in, for instance, mortgage rates that might go up in time. Muni is a tax-free municipal bond fund. QQQ is a technology-focused traded fund, or exchange traded fund, or ETF as they're often referred to, which invests in the entire industry of classes and have lower management fees than professionally managed mutual funds. There's also like VQNPX, which is a growth and income fund. SPY is an ETF trust that buys stocks of the 500 biggest companies. Or AOA is an aggressive growth ETF. So those are just examples of these funds that you can invest in. If you don't want to get into learning about individual companies or you're risk adverse, a lot of times you can invest in a particular sector, and if you believe in that sector going up in the economy. There's alternative ideas too, like Fundrise.com is a crowdfunding real estate company. Now, those didn't exist that many years ago. They were illegal. But now and the average investor can invest in these big, larger real estate projects, which is nice because it's a way of owning property without the hassles of being a landlord. And sometimes that can pay even a 6 to 7% annual return. So the interest on those are nice, even as property values may go up additionally. Also, think about Utah's 529 plan. If you want to raise money for education, it can be done tax-free through 529s, once again named after the tax code line item. All states offer them, and some have tax advantage for their own residents. But Utah is one of those few states that allow you to do it yourself online. It's always rated one of the best in the country because brokers won't recommend it because they don't get a commission because you're doing it yourself. So that's just something to keep in mind. But there's several good 529 plans. Utah is just one of them. You can also buy physical real estate. You can purchase properties in areas that you think are going to appreciate in value, mainly, usually because of population increases, or just to rent out to other people. You may want to pay an agency to handle the renters, so you don't have to do it yourself. This can often cost about 10% for full-time rentals, or higher if you're doing like nightly rentals in a vacation area. But just make sure you do the math on how much the property will actually cost, including mortgage, utilities, property taxes, maybe HOA maintenance. There's all kinds of extra things that can go in that skew people's initial real estate rental property investment plans. So look at really what revenue you can bring in from rent, and then your real costs of running a house, including the agency fees. Most people also build wealth by buying the home they want to live in for a while. If you have a mortgage from a bank to help pay for it, the interest on that mortgage can actually reduce your taxable income as well. So talk to your tax preparer about that. You can also invest in small businesses. You may have a great idea to start your own business or buy into someone else's idea, but be very selective on who you choose to go into business with and who is running the business. Almost half of all new businesses go under within 5 years of opening. Not to discourage anyone, because many people can do very well. But just be careful doing business with family or friends. Money can put a lot of strain on relationships. You can buy fine art that appreciates in value, or music publishing rights. There's peer-to-peer lending companies like lendingclub.com that allow you to lend money to other people and you earn the interest. But this type of investment is not liquid, meaning you can't cash out whenever you want, and you have to commit to keeping your money in for a certain amount of time. Like stocks, if you need the money, even if you pick a stock that's gone lower, you can at least take the money out pretty much instantaneously these days, even if you took a loss. But some of these investments, you got to really think through when you're going to need the money and when you can get it out. There's also more complicated investing, like shorting stocks or buying preferred shares of companies, etc. But I recommend to keep these things simple until you learn more about it. And if you can, like I said, read the Wall Street Journal, which in my opinion is one of the last politically unbiased news outlets that will keep you current on investing ideas, laws, and newsworthy items. So if this, hopefully you learned a little bit of something and you can go back and reference it, but these are just some general rules that I've stuck to as far as spending, investing, and saving fundamentals. I hope you got some value of it. Thank you for your time. My name's Stephen Staats. Appreciate it.